Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Tensions over trade between the U.S. and China seemed to soften a bit during the last session. Both sides signaled over the weekend a willingness to keep negotiations alive after each made a series of threats. Now, President Trump talked about an increase in tariffs on Chinese imports to 100%. He seemed to be reacting to new Chinese restrictions on the export of rare earth minerals. The timing was very interesting since the trade data from China for the month of September blew past estimates. On Monday, Beijing reported outbound shipments rose 8.3%. That's the fastest pace in 6 months, a total value of $328.6 billion US dollars. Later in the day, we heard from Treasury Secretary Scott Bessent. Now, he was saying all options are open for the U.S. to retaliate against China's move to tighten exports on rare earths. Here's Bessent speaking to Fox Business.
Here in the U.S., we have an all-hands-on-deck policy. This is something that we didn't get here in a day. This has been the failure of previous administrations over decades not to see this strategic whole.
That was U.S. Treasury Secretary Scott Bessent speaking to Fox Business. For more on the latest between the U.S. and China in terms of trade, we heard from James Aitken of Aitken Advisors. He spoke with Bloomberg's Paul Allen at the ANZ Investment Conference in Sydney.
The last few days have really been fascinating, and it's perfect timing to have you walk us through it, because it's just given us another example of how markets can be so suddenly upended by rhetoric and changes in trade policy. And we've also seen a re-emphasis of the so-called taco trade. Trump always chickens out, but you're warning if there's another acronym to be careful of, and that's the FAFO trade. Do people need to be careful? Can you always rely on that taco trade?
Yeah, I think that's a great place to start. I mean, look, we've had a bit of FAFO, we've had a lot of taco, and certainly, let's be clear, the market is betting once again that this is another taco episode. I'm not so sure, but before we think about the path ahead, let's think about the conditions that prevailed as recently as the middle of last week. So unsurprisingly, people were all in. Systematic investors were all in. Everyone was all in and levered long equities, which makes a lot of sense. It's the right thing to do. But Wednesday last week, per the Bloomberg terminal, 10-day realised correlation on the S&P 500 fell to zero, which is about as low as it can go. 10-day implied correlation on the S&P 500 fell to about 5 or 6, which is as low as it has been. And the point I'd make is that the initial conditions ahead of Thursday, Friday last week were already very stretched. It didn't particularly matter what might come up to disrupt that, but we were primed for some kind of disruption. And of course, it got knocked over by a resumption of the rare earths contest, which is what it is. And look, I know it sounds a little bit dramatic, but we have been in a rare earths Cold War now for a long, long time. It's just that it's only burst to the surface, and what we're seeing of late is a taste of what's to come.
How do you see this situation evolving? Because we heard from JP Morgan today, it's going to funnel another $1.5 trillion into that rare earth sector, and Jamie Dimon saying, look, this isn't charity, this is just a sensible move. So is this an opportunity here, or is it more, as you sort of referred to with the FAFO, chance for damage limitation?
Let's differentiate. Markets want to bet that there's a dip, you buy, the party resumes. Okay, that's a path. But what we're actually seeing, and whisper it, is that everything is being subjugated to national security, which I'd argue is long overdue. So all this debate which you've talked about inflation targets, spend independence, look, if it's all about national security, which I think it should be, then everything is subjugated by that. So inflation targets are important, but we've got a whole bunch of investments we need to make ourselves more resilient across the West, more resilient even, and that's barely started. So yes, it's an opportunity for all sorts of investors to participate in, let's call it a national security rebuild. It's long overdue. It starts first and foremost with critical minerals and rare earths, and Australia has plenty of those, but it's more broader than that. It expands the supply chains, and I think what Jamie Dimon announced yesterday is commendable in the extreme, and I think it's a taste of what's to come.
Now, you mentioned a moment ago a number of S&P metrics that suggested what happened was predictable. However, the only metric that really matters to investors is, well, we saw it again this morning, the S&P hitting a level that we haven't seen since May. So that rally just keeps on rolling on. But are you seeing any warning signs longer term that could come undone? Because typically the only thing that would stop it is a recession, but is there anything else you're watching?
Yeah. You're right, at a headline level, happy clappy, let's muddle through, let's continue to play the game. Absolutely right, and that's the implied bet of the markets. But you dig beneath the surface or under the hood and you see absolute turmoil. We've just had one of the biggest factor smash-ups in a long, long time, shades of the GameStop debacle in 2021. So on the surface it looks serene and calm and the game rumbles on, but under the surface it's been massively disruptive. And unsurprisingly, any time correlations rise and realised volatility rises, that's very difficult for the leverage market participant. And regrettably, there was an awful lot of damage across an awful lot of risk-taking silos on Friday. And again, as much as the sentiment is, let's put the party back on, up we go again, I think risk appetite is going to be fairly subdued for a little while to come.
Feels like a good moment to ask you what the rally in gold prices means to you, and can it continue?
Look, I'd love to give you a really clever answer. Frankly, I don't know. All I can see is walking down Martin Place as people queuing up outside the gold bullion shop. Now, I don't know if they're buyers or sellers, but there's clearly something going on. Look, I'm watching it with interest. I'm watching it in the context of a broader rally in commodities. Historically, if gold did something like this, Paul, you would have said, uh-oh, watch out, the dollar's going to go down as well. But so far as we can see, the dollar's holding in. So I view gold as a special situation. It's interesting in the recent past that implied volatility on gold has started to shoot up as well, which hasn't happened for a while. Maybe suggesting this gold rally is a little bit long in the tooth. But look, to state the obvious, it's very difficult to sell.
Well, of course, gold priced in US dollars as well. And we've seen the US dollar gaining in the Bloomberg Dollar Spot Index about 1.5%, give or take, on month. But considering the trade tension, the rolling government shutdown, Fed easing, ballooning US debt, AI bubble risk, what's driving dollar strength right now, and can it last?
Inertia. What's driving it is inertia. Look, there's two big decisions that global savers, global investors have had to make in 2025 and probably 26 and beyond. It's like, A, what do I do with my underlying US dollar asset exposure, private credit, equities and so forth? And B, what do I do about the dollar? And these large pools of capital can, move money around, but no market offers the capacity that the United States does across a range of instruments. And you remember 10 years ago, the world made a very smart bet. Collectively, the world went overweight unhedged US assets and equities in particular. It worked really, really well, which means the bar to changing that allocation is very high. There was a big test of that in February, March and April, as we all recall. But again, those cumulative gains are so large that there's this inertia that drives strategic asset allocation around the world. So are people nervous, apprehensive? Absolutely. Are there some conversations around town about how should we think about dollar hedging and everything else? Absolutely. But by and large, so good has been the performance of the underlying asset exposure that people have decided that they'd take the option of waiting and seeing. And that, I think, explains a large part of the dollar resilience. So the fast money ducks and weaves through foreign exchange markets. The really big money is just sitting back and watching and enjoying their enormous cumulative rolled up gains.
That's James Aitken of Aitken Advisors speaking with Bloomberg's Paul Allen. In the States, the equity market advanced thanks to a rally among chip stocks. Coming up, we'll look at the market with Matthew Tuttle of Tuttle Capital Management here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Semiconductor stocks grabbed the spotlight in the U.S. session. That was after OpenAI agreed to buy custom chips and networking equipment from Broadcom in a multi-year agreement. Shares in Broadcom rallied nearly 10%. Joining me now for a closer look is Matthew Tuttle. He is the CEO, also CIO at Tuttle Capital Management. Matthew is on the line from Greenwich, Connecticut. Thanks for making time to chat with me. I'd like to begin by asking you, in relation to this OpenAI-Broadcom deal, whether it feels a little like late cycle to you.
It does. I mean, I definitely think that you want to be in these AI stocks. I do think we're late in the cycle, but that doesn't mean that there still aren't a lot more gains to come. I think you've got to be careful with it. You've got to be cognizant of the fact that we are probably in a bubble. At some point, the bubble is going to burst, but that could be a year from now, 2 years from now, 3 years from now. So until then, we tell people trade based on what you see. And what you see is these AI stocks go up, and you want to be buying the dips like Friday.
So in terms of what we're going to be hearing from these companies, the hyperscalers, everybody in that space that begins reporting third quarter numbers, is it really the CapEx figure that's most important to you?
That is going to be huge. As long as that spending spigot continues to be wide open, then we think you've got to be buying this market. The second that people have kind of that where's the beef moment where they're wondering, wait, how are we going to make money off of all of this spending? That's when this starts to unravel. And, you just got to be hyper vigilant on all these earnings and what the CEOs are saying, and watch for signs of that.
Let's turn our attention to the other earnings that we're going to be getting. Tomorrow, we'll hear from some of the big banks, including JP Morgan. The stock was up today by more than 2%. A lot of focus here on trading revenue, on fees from investment banking. Broadly speaking, will the big banks deliver pretty strong quarterly results?
I think they'll deliver decent results. I'm not a big fan of the banks. I think this market has become completely thematic. And I really think you want to stick with a lot of these top themes. We did see, Friday, big sell-off. But coming into Friday, you saw a lot of sectors that had really kind of turned and were looking wobbly even before that. So I would personally just focus on these bigger themes. But I think the banks are going to be okay. It's not an area that's of interest to us.
In terms of themes that would impact the banks, I would imagine Fed rate cuts are a part of that story. Anna Paulson today, the head of the Philly Fed, was essentially indicating 2 more quarter-point rate cuts are called for this year. She's very much focused on the risk to the labor market. Is the Fed at risk of maybe ignoring the inflationary pressures that still are above target and they seem to be persistent?
Yeah, the Fed, in my opinion, has gotten a lot wrong over the past couple of years. And they do run the risk of, kind of missing inflation like they did the last time. Right now, all the market cares about is they're running it hot. And, so AI CapEx to me is number one. Fed continuing to cut rates and run it hot short term is number two. Again, another risk to this market is if we end up in some sort of stagflation environment, that's not going to be good.
So late in the day, Monday, New York time, we had the price of silver jumping to an all-time high, $52.50 an ounce. When you look at the price action in not only silver, but gold, what do you come away with? What's your take on this?
It's the debasement trade. It's people moving out of fiat currency, and it's related to crypto. Crypto's got its own little unique things to it, and you saw kind of that sell-off Friday and a little bit over the weekend. But it's really, at the end of the day, it's the same trade. It's people, losing faith in the central banks, all of the debt, and getting out of fiat currency into, the alternative currencies.
One of the things that we need to talk about, the trade relationship between the U.S. and China. Over the last couple of trading days, things were on the hot side rhetorically. Mike Wilson from Morgan Stanley, he's the chief U.S. equity strategist, was saying that there could be a larger than expected correction in U.S. equities if Presidents Trump and Xi failed to resolve their escalating trade tensions. Do you agree with that? Is the trade story being largely ignored by the market right now?
So to me, the trade story is kind of a sideline. Could there be a correction? There could. But to me, that becomes a buying opportunity as long as AI CapEx spending is chumming along. and as long as the Fed is accommodative. I think Trump has shown you this playbook, and, we believe in taco. Trump always chickens out until proven otherwise.
Where are you finding value in U.S. equities right now?
Value is a tough one. Not a lot of places. You really, when you're buying these themes, and I'm a fan of all the AI infrastructure. I'm a fan of space. I'm a fan of drones. I'm a fan of anything kind of rare earth. And then, I love gold and I love crypto. But value, you've really got to hold your nose and say, look, for right now, and eventually valuations matter. But for right now, in this market, valuations don't matter a lot.
I'm thinking about the power that's required to drive this data center compute, maybe away from the utility companies and the power producers. Think about the companies that actually produce the turbines that create the electricity. Is that an attractive trade to you?
That's an attractive trade to us. The GE Vernovas. It's really all of, the cooling, natural gas. There's just so much to this AI trade. And then you can even take it to the third order. Who's going to build the data centers? Who's going to provide those materials? There's just so much in there. Again, which is why something like banks, when I've got such a target-rich environment, I'm just not interested in the banks.
Okay, fair enough. But if you had to look at a tech industry away from artificial intelligence, something away from, let's call it a pure play on semiconductors, something we don't often discuss, such as robotics, I'm wondering whether robotics is an area that interests you at all.
Robotics is huge. My number one that people don't talk about is space. And that's a ways out. But there is for example, there are things that you manufacture on Earth that gravity messes up that can be done in space. I think eventually we're going to have a whole infrastructure which is going to require defending it, transporting things back and forth, building these, satellites or whatever we have up there. That's really interesting to me. That would be my number one kind of out there that you're not talking about. Robotics would be number two.
We'll leave it there. Thank you so much. Matthew Tuttle is the CEO, also the CIO at Tuttle Capital Management, on the line from Greenwich, Connecticut, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.